Welcome to Descript with Henry. Today, we're diving into a serious topic that every crypto investor, new or experienced, needs to understand: how to spot a crypto scam in 30 seconds. And we're starting with the most obvious red flag: guaranteed high returns.
Exactly. Red flag number one. If someone promises you 20% to 30% return per month or even per week, run. That kind of return is not only unrealistic, it's mathematically unsustainable.
But what if they show screenshots of other people making that money?
Most likely fake. Anyone can Photoshop a dashboard or fake a MetaMask balance. Or worse, they show you real results from a Ponzi model. Early investors do get paid, but only using the money of newer ones.
So it looks legit at first?
Yes, that's the trap. It starts slow. You deposit $1,000 and in 30 days, they show $1,300. You think, wow, it works. So you put in $5,000 more, or tell your friends to join. That's when the scammer wins. They gain trust, and then they disappear.
Why do so many people fall for this? Isn't 20-30% a month obviously too good to be true?
Because in crypto, big gains are possible in rare cases. People hear stories of someone making 10x or 100x from an early token, and they confuse luck with consistency. Scammers exploit that. They don't say you might 10x, they say you will earn 30% monthly, guaranteed.
And crypto's unregulated nature makes it even easier?
Exactly. No central bank, no authority to complain to. Once your USDT is gone, it's gone. The scammer can close the Telegram group, delete the website, and vanish.
So how can people avoid this red flag?
Simple rules. 1. If returns are guaranteed, it's a lie. 2. If it sounds too good to be true, it is. 3. Real projects don't promise specific profits. They offer technology, utility, or long-term value.
Can you give a real-world example?
Sure. Take BitConnect, the most infamous crypto scam ever. They promised 1% interest per day through a trading bot. People believed it. In 2017, BitConnect's token hit a $2.5 billion market cap, but in early 2018, it collapsed. Turns out there was no trading bot, just a Ponzi scheme.
So if I see a new project offering fixed daily returns, I should
ask, where is the money coming from? If there's no product, no service, no external revenue, then you are the revenue. And soon, you'll be the exit liquidity.
Powerful. That's red flag number one. In the next segment, we'll talk about another major warning sign: anonymous teams. Who's really behind the project? So we've talked about unrealistic profits. Now let's get into the second major red flag: anonymous project teams. Henry, why is that such a big issue?
Red flag number 2. If you don't know who's behind the project, don't invest. It's that simple. Would you give money to someone wearing a ski mask and refusing to tell you their name?
But some people argue that Bitcoin was started by Satoshi Nakamoto, an anonymous person. Doesn't that mean anonymity can still work?
That's a common argument, but Satoshi never raised money. He didn't promise 20% a month. He released open source code, disappeared, and let the community take over. That's completely different from an anonymous team launching a token and asking people to send them millions.
So the problem is anonymity combined with fundraising?
Exactly. If someone wants to build a project in DeFi or GameFi and they're asking for money, they should be held accountable. That means a real identity, a LinkedIn profile, a professional background. If anything goes wrong, you know who to confront.
So what do legitimate projects do to build trust?
They practice something called doxing, which means the team publicly shares their identity. Not only that, but many get KYC verified by launchpads or auditing firms. They also join live AMAs, show their faces on video, and even link their real-world credentials.
And if a project says, "We're anonymous for our safety,"
then they shouldn't be asking for your money. Security concerns are valid, especially in crypto, but transparency matters more. If they want to stay anonymous, they should build a free tool, not launch a financial product.
fair. So how do we verify a team is real?
Do this. 1. Google their names. See if they have consistent online profiles. 2. Check LinkedIn. Do they have relevant work experience? 3. Look for interviews. Have they ever shown their face? 4. Audit the audit. If they claim KYC or identity verification, check who did it.
Because if they can't show their face, they probably can't show you the money.
Exactly. In crypto, anonymity is the favorite shield of scammers. Real builders want to be known, trusted, and held accountable.
That's a strong warning. So red flag number 2. If the team is anonymous and you can't verify them, walk away.
Walk fast. Because when things go wrong, you'll realize you were betting on a ghost.
Coming up next, a tricky red flag that's hard to notice. Projects with no real product, only buzzwords and roadmaps. So far, we've talked about unrealistic returns and anonymous teams. The third big red flag is projects with no actual product, only vague promises and roadmaps. Henry, why is this such a problem?
Red flag number 3. If a project can't show you a working product or prototype, be very cautious. Many scammers create fancy websites and white papers loaded with buzzwords, but have zero working technology behind them.
I've seen websites with slick designs, diagrams, and huge claims about revolutionizing finance or disrupting industries. But when you dig deeper, nothing real.
Exactly. They lure investors with ambitious roadmaps that stretch years into the future. But a roadmap is just a plan. It's not a guarantee. Real projects build first, then pitch. Scams pitch first, then build, or never build at all.
So what questions should investors ask to avoid falling for this?
Simple. 1. Can I try the product or beta? If the answer is no, be suspicious. 2. Are there independent reviews or demos? Check for third-party testimonials or GitHub code. 3. Is the white paper detailed and realistic, or full of jargon and buzzwords without substance?
What about projects that say, "We're still in development, trust us"?
That's a classic stall tactic. It's fine to be in development, but don't put money into vaporware. If there's no MVP, minimum viable product, within a reasonable timeline, you're probably being strung along.
Any famous examples?
Sure. BitConnect again. Before it collapsed, they had no real trading bot. The technology was a black box. People just trusted the hype.
So investors should always look for proof of concept?
Absolutely. If you can't see or test the product, you're investing in a fantasy. And fantasies don't pay dividends.
Got it. That's red flag number 3. No product, just empty promises and long roadmaps.
Exactly. Keep that in mind before you click invest.
All right, Henry. So we've covered unrealistic returns, anonymous teams, and no real product. Now let's talk about the fourth red flag, projects that rely on multi-level marketing or Ponzi schemes. What should people watch out for?
Red flag number 4. If a project pays you commissions or bonuses for recruiting others, that's a huge warning sign. Classic Ponzi schemes and MLMs survive by bringing in new investors, not by real revenue or product sales.
But isn't referral marketing common in many legitimate businesses?
Yes, referral programs are normal. The difference is in the emphasis. In scams, recruitment is the main or only way to make money, not the product or service.
So how does a Ponzi scheme work in crypto?
It usually looks like this. Early investors get paid with money from new investors. To keep the cash flow going, the scam depends on constant recruitment. When new recruits dry up, the whole scheme collapses.
And MLM?
Multi-level marketing adds layers. You earn commissions not only from people you recruit, but also from their recruits. This pyramid structure makes it unsustainable and very risky.
Got any examples?
One infamous case is OneCoin, a global crypto MLM scam that raked in billions before law enforcement shut it down. They promised huge returns, but the coin was worthless, and profits came solely from new members' fees.
How can people spot this kind of scam early?
Watch for these signs. 1. Heavy focus on recruitment bonuses or rewards. 2. Pressure to bring friends or build your team. 3. Little to no emphasis on actual product value or use cases. 4. Complicated commission structures that sound too good to be true.
So if the project's success depends on recruiting your friends and family, it's probably a scam?
Exactly. And that creates social pressure and risks relationships. It's not just your money on the line, it's your friendships.
That's a serious warning. So, red flag number 4, if recruitment drives profits, avoid at all costs. Henry, we've now talked about Ponzi schemes and MLMs. Let's move on to the 5th red flag, tokenomics that silently kill your investment. Can you explain what that means?
Red flag number 5, beware of projects with poor tokenomics, especially those with massive token inflation that devalues your holdings over time. It's like printing money endlessly. You get diluted.
Sounds technical. What exactly should investors look for?
Key points. 1. Total supply and circulating supply. Is the circulating supply only a tiny fraction of the total? 2. Vesting schedules. Are team tokens or private sale tokens unlocked too quickly? 3. Inflation rate. Does the protocol keep issuing new tokens at a high rate, flooding the market? If a project mints millions of tokens daily and dumps them, early investors get crushed.
So it's not just about price going up or down, it's about how many tokens are in circulation.
Exactly. Imagine you own 1% of a company. If the company suddenly doubles the shares, your slice is now 0.5%. Same with tokens.
Are there scams that hide this from investors?
Many. They emphasize price gains but never disclose inflation mechanics clearly. Sometimes the white paper has confusing or missing info.
How can investors protect themselves?
Do your homework. Read the tokenomics section carefully. Check how many tokens the team holds and when they unlock them. Use tools like tokenomics explainers or community audits. Also, watch out if token distribution favors insiders heavily.
Any notorious examples?
Yes, projects like SafeMoon had massive token inflation and huge rewards for holders, but also massive selling pressure from early insiders, leading to rapid crashes.
So red flag number 5 is poor or hidden tokenomics that cause your tokens to lose value no matter how the price moves.
Exactly. Understanding tokenomics can save you from silent losses.
Henry, we've covered a lot already. Now let's talk about something that trips up many investors: fake influencers and pump and dump schemes.
Red flag number 6. When you see big hype around a project pushed by influencers with questionable credibility, be careful. Many so-called crypto influencers are paid to hype coins, then dump their holdings once prices spike.
How do these pump and dump schemes work?
Typically, a group buys a large amount of a low liquidity token at a low price. They then promote it heavily on social media, often with paid influencers or bots, to create fake excitement. New investors rush in, pushing the price up. Once the price peaks, the insiders sell, dump, crashing the price and leaving others with losses.
So the influencers aren't always honest?
Not at all. Many are incentivized by the projects or get paid under the table. Some even create fake accounts to spread hype.
How can regular investors spot this?
Look out for sudden, unexplained hype with little substance. Influencers who push multiple obscure projects in a short time. Promises of get rich quick or exclusive early access. Low liquidity tokens that have wild price swings.
Is there a way to verify influencer credibility?
Check their track record. Have they been transparent about their holdings? Do they disclose paid promotions? Also, beware of anonymous or newly created accounts with big followings.
Any memorable pump and dump cases?
Yes, projects like Squid Game tokens surged overnight due to hype, but turned out to be a scam, with the creators disappearing and investors losing everything.
So red flag number 6, if the hype feels manufactured, do your research before investing.
Always. Don't let FOMO blind you. The crypto world has a lot of noise. Focus on fundamentals, not just hype.
We've come to our final red flag, Henry: lack of audits and weak security. How important is this when evaluating a crypto project?
Red flag number 7. If a project hasn't undergone a thorough smart contract audit by a reputable firm, it's a huge risk. Smart contracts manage your funds automatically, and vulnerabilities can be exploited to steal your money.
But audits can be expensive and time-consuming, right?
True, but any serious project raising significant funds invests in audits upfront. It's a basic sign of professionalism and care.
How can investors verify if a project has been audited?
Good projects proudly share audit reports on their website. You can check the auditor's credentials too. Watch out for outdated audits or missing reports. Audits done by unknown or low-quality firms. Projects that avoid answering questions about security
And what happens if a project's contract is hacked?
funds can be drained instantly. We've seen multiple rug pulls where the team exploits vulnerabilities or outright steals funds.
So is it fair to say audits don't guarantee safety but reduce risk?
Exactly. Audits are no silver bullet, but skipping them is a major warning sign. Combine audits with other checks like code transparency and community trust.
Final thoughts for investors?
Be skeptical. Do your due diligence. Protect your private keys. Never invest more than you can afford to lose. And always verify the basics: team, product, tokenomics, security.
Thank you, Henry. Those 7 red flags will help everyone avoid common crypto scams.
Glad to share. Stay safe out there.